In this monumental roundtable episode, we have traders with over 30 years of market experience and millions of dollars in verified profits.
When people start into a prop firm world, the core education and how to emotionally manage risk goes away. You say, okay, I spent $100 on this. If I blow up, who cares? You totally skip the education and learning of how do I feel when I take real risk? How do I feel when I put my own money on the table? How do I actually learn to trade?
Vincent Desiano with over $1 million in verified profits trading only break and retest strategies. Dylan O'Neill, a real prop firm trader managing private investor capital. Carmine Rosato, a brilliant 7-figure trader and a recognized order flow expert trading real fair value gaps.
Everybody should know what their setups are, and their job is to just locate those setups on a daily basis. When you see that opportunity, you have to put risk on the table and take that setup.
Can you describe a high conviction play for you, just in terms of technicals?
So in terms of technicals, I'm mainly looking for... There's a lot of noise online. It's human nature to compare. Hey, he just took a good win. I want to learn his system. He just took a really large loss. Forget about him.
Once you find some success using a single setup or strategy, you need to explore that road and you need to start to defend from different ideas coming into your brain. There is definitely a point where you do have to start exponentially focusing on one single thing.
Whether I'm trading Bitcoin, crude oil, or S&P, it's the same exact procedure once I'm in a trade. I have no idea if it's going to hit one target or 6 targets, but I accept that. If it does trend, I outsource my decision making to the process.
What is in that process?
So once I'm in the trade, right?
Ladies and gents, welcome back to another episode. I'm joined by a very nice panel today. We've got Vincent, Carmine, and Dylan. So we have a variety of experience between all of you. It's decades of experience and futures and options. So I want to take this episode just dispelling myths, because retail traders coming into the industry, a lot of things have changed compared to the era you guys started out 10, 12 years ago. Let's start off with prop firms, access to capital, because for options it's like 25k and above is what you need to get started. It might be a blessing or a curse to have prop firms coming into it, futures, but it also brings in bad, short-term thinking and so forth. And then we have a real prop firm trader over here with Dylan. So let's throw that out there of just how the industry is navigating at the moment.
I'll let Carmine start on that because I know he's more of the futures guy, and then Dylan go into, and then I'll finish off with how it sort of differs in my world.
Cool.
So I wouldn't consider these online prop firms that majority of these retail traders trade with as real prop firms. They're mainly, I think, companies that promote gambling and promote not so much trading, but more so, I guess, they gamify the markets, so to speak, versus somebody like Dylan who works at an actual prop firm that provides tools for traders to succeed and actually make money for themselves and actually make money for the firms. These online prop firms, I think, are a terrible tool for traders, especially beginner traders looking to build a strategy to use because, again, they gamify it. It's very simple. You spend, $40, $50 on an account. You take a couple of trades. You lose that account. Okay, your risk is $50. There's no real hard-earned money that you're putting into the market. There's no actual orders hitting an exchange. There's really no connection to you in the market. And I think that, for a beginner trader, is probably one of the worst things to establish when you're trying to build and develop a strategy versus somebody being in an actual firm. They want you to succeed. A lot of these online prop firms, their business model succeeds when you fail. So I think it's backwards, and a lot of traders are walking backwards, or they're trying to walk up the stairs with like a weighted backpack on them, and they're just putting all this weight on them, and their time to be successful is just diminishing by going with these prop firms.
Yeah, so the way I look at it is when people start into a prop firm world, when they start to get into that, they're really just chasing money, right? They're looking to spend $100 a month, get a payout, and make money, right? But the core education and how to emotionally manage risk goes away, right? So you're not actually using your own hard-earned money in a trading account, right? So you say, okay, I spent $100 on this. If I blow up this account, who cares, right? So you totally skip the education and learning of how do I feel when I take real risk? How do I feel when I put my own money on the table? You're just sort of chasing the payout versus how do I actually learn to trade? How do I actually learn to manage my emotions in a position that I have real money on the table? And I think if you skip that part of trading, that very harsh part of trading, which sucks for a lot of people because you go through periods of drawdown, you go through periods of losing your own money. But I would 100% confidently say that I'm not where I am today without going through that risk, without going through those experiences. Because now I know how to manage that emotionally, physically, right? But if I just skip that and try to get payouts, I think you miss a very large, important chunk.
It is a very good tool for traders to, once they have the system built and the strategy,
Yep.
to leverage those firms. Absolutely. But I think for a trader who's still struggling or looking to develop, I don't think it's a very good route for a lot of traders to go, because you skip that necessary step of really building that mental fortitude of having the losses. My losses were probably some of my best lessons in the market. So having those and having that provided, it gave me like a strong backbone to my trading strategy, and it's just amplified wins in the future.
Yeah, like if Carmine stepped in and signed up for a prop firm and just did exactly what he's done and knows, he probably would do well, and he could probably use some risk-free money and do well. But it's because he's gone through the trial and error of actually learning how to educate himself in trade.
It might also be twofold, in the sense of you might do great in a prop firm, but those that gamify it might do even better, but on a real account they would struggle.
Exactly.
Because they know that, okay, if I just do a bit more risk, I can squeeze it, and if it goes wrong, I can just reset with another $50. So it brings in maybe bad habits, whereas if you go 10% in the red, you got to climb out and deal with it and sit with those emotions. Then let's bring you into, so you're a real prop firm trader. So when you hear the online prop firms that are kind of a new emergence, drawing parallels and differences between the real prop firms, the environment you have, what it's like at the desk, between the tools you have around you, the resources, and the online version of it.
For sure, yeah. Carmine touched up on it already, but with the online funding programs, right, they give themselves that prop firm name to build credibility, right? So when their consumers lose, the online trading firms are making money. Okay, that's the business model, and by pure definition, to me, it sounds like a scam. In terms of me, when the traders at the firm that I work at make money, the owner makes money as well. So it's all collaboration, right? If we do poorly and we lose money, guess what? The owner of the firm loses money as well. So it's the total opposite from the online funding programs. In terms of resources, again, like Carmine said, we have a ton of resources. I mean, we have a risk manager. We have, all of the different guys that have been there for decades have gone through a lot of the similar obstacles that, I might go through. So, it's very, very helpful to kind of go through an obstacle and have someone sitting in the same room that has gone through a similar obstacle, where I could, say, hey, this is what I've been going through. What might help me? And they could say, all right, I went through that years ago, or so on and so forth, and give me the right tricks and tips to efficiently and effectively get me over that road bump, per se.
In the general trading space, it's almost a lone wolf environment. You got to deal with all your emotions yourself, the risk yourself, that going on tilt. Whereas in a office environment where you have a team and shared resources and shared ideas, does being as a team trader sometimes maybe even cause conflicting ideas and then maybe analysis paralysis, or is it always beneficial?
In the beginning, I struggled with that, because there would be times where I would have a solid setup forming, and I would have some edge in what I look for, and another trader would have a conflicting idea, and I would just assume, like, oh, this guy's been trading 24 years, he probably knows something that I don't. I would not take it, and lo and behold, it would end up working how I expected it to. So that was definitely something that I had to get over. And beyond that, now it's been about 4 years that I've been there. So the only time that I kind of give context to the others is if I see something that aligns with what they're seeing. So if I see something that's a little contradicting to what they're seeing, I don't even say anything, because I don't want to steer their thesis, steer their conviction, right? So now if I see something very, very glaring, as in terms of if something's really, really significant that's going against their analysis, then I will, kind of hint at it and say, hey, I respect what you're seeing. I'm sure that the thesis is very, very solid, but this is what I'm seeing on my end. So, take what you want with that information.
I think that actually correlates pretty well with like an online trading community, right? Because at the end of the day, we want to help people learn and educate them the best we can. But I think it's very important for everyone to always have their own ideas, their own thesis, because you don't want someone else, coming in the way of an idea that you think could work, you want to always try that and give it your, if you think it's right, try it, right? Sometimes, let's say Carmine might have a conflicting view on a trade that I'm looking at, and both of us take the trade, maybe it's opposite, but we learn from it. So, I think to just totally disregard a position that you like because of someone else probably happens quite a bit in some of these, and even mine and other online trading communities.
I want to take a moment from the episode to remind you of Alpha Capital, a long-term sponsor of the show, a leading prop firm in the entire industry, and in the last year they did over $50 million in payouts. That's why they are a top-ranked prop firm that's been around for years and is not going anywhere. And with the multiple step plans they have and the multiple packages that they have, there is going to be something catered specifically to your needs at the most competitive pricing. And because we have a long-term relationship with them, we are able to bring you a massive discount of 20% off all evaluations. So click the link in the description or use the code TOT to get 20% off all your funded accounts. Working with the best prop firm in the industry, Alpha Capital. Brings me on to the point of just conviction. And I think the answer to these things is, okay, you might be wrong on one day and your colleague might be wrong on the other day, but over time, your edges are carved out. So over time, both of you will be profitable despite at times overlapping and at times conflicting. But in general, on a single trade basis, conviction on a play where you got other people's judgment, people maybe more experienced, or a community where you're following the same strategy, but people's nuanced subjectivity of it changes outcomes. And just in general, people around you, how do you navigate just conviction? Let's start off with yourself, Carmine.
Well, I feel like the brain's like a muscle, and the more you work it, and in market terms, it's the more you're watching the market on a daily basis, the stronger it gets and the stronger it grows. So you build conviction through experience, and you build conviction through years and years and years of taking trades, winning on certain setups, losing a lot of other setups, and knowing subconsciously and intuitively that what setups are that give you a higher probability of working out versus a lower probability of working out. And there are plenty of setups. Like if you look at everybody, even on this table right now, we all have the same, or we have different setups, but we know what our setups are. And there are times where maybe I conflict with Dylan, I conflict with Vince, and maybe even though we're still conflicting, we still all make money on our different setups. But everybody should know what their setups are, and their job is to just locate those setups on a daily basis. When you see that opportunity in front of your face, you have to put risk on the table and take that setup. And I think the big thing about trading is knowing what your setups are, because you could only build conviction by years of trial and error, months of trial and error, and knowing what works out for you more often than not, and what has a higher probability of moving in your favor.
Yeah.
Can you describe a high conviction play for you, in terms of technicals?
Yeah, so in terms of technicals, I'm mainly looking for where a lot of traders are going to be trapped at, or where a lot of traders are going to be stopping out at, because I think when a lot of people are acting upon impulse or acting upon emotions, that's the greatest edge to take advantage and make money in the markets, is when people are acting upon impulse, they're fearing something, they're very greedy with a setup, and there's a lot of volume pouring in the market around it. I think that is the best opportunity for me to be active.
Is that usually in a zone of consolidation where the stops above, there's breakout traders, there's a lot of activity, or is it impulse in terms of a lot of trend, people trying to FOMO in, etc.?
Well, it could be both. So it could be at a level of interest. It could be, anywhere where I know a lot of traders are going to be longing a breakout or shorting a breakdown or stopping out at, or it could be in the middle of the range. It's just I'm reading the volume around the price action. And before I wake up or before I go on my charts, I don't know how other participants are going to perceive price action. I don't know if they're going to be euphoric and buy the market up or sell the market down, but I know that when I'm watching the market develop in real time, I have the tools needed to understand how other participants are feeling about price, who is in pain, who is gaining, and I could get a good sense and a great edge in that.
Transitioning nicely to you as a kind of breakout trader, I wonder if there's opposing views or collaborative views on this.
Yeah, I think it's very similar, because what he notes about where people get emotional or where they are looking to take a position, that's always happening at a major key level on the market, right? So like if you're pushing into a very key area of supply on the markets, there's going to be a lot of different participants there. And that's exactly where I'm always looking to take advantage of pretty much the same thing that Carmine does. The way we trade is very similar.
Okay.
I think I make it a little bit more simple, and he probably makes it, he gets his confirmation through really complex ways, but it works for both of us. And it's the same thing, right? Key levels for me, decisions at key levels where I know inflections are coming, where a lot of traders are focused, because in my opinion, the first 2 hours of the day is when most retail traders are active, and that's where the most edge is. Trading is, you have to be right, someone else has to be wrong. And the likelihood of me being right versus 9:30 to 10:30 FOMO traders that are just clicking buttons is much higher, and that's where I try to make the most money, right? Versus the the midday where it starts to become very algorithmic driven. I try to stay away from that. There's a lot more emotion and FOMO going on in the first hour and a half.
So to the point of, let's say, conviction, or let's say you're in a losing period and you wanna make sure your next few trades are winning trades.
Yeah.
You skew it based on time of day mainly.
I stay very far away from anything past 12 to 1 o'clock Eastern.
Okay.
I've noticed that my trading deteriorates, both because of my mental, right? Because you can't sit in front of a computer, in my opinion, and perform at that level for that long. I start to I can feel my performance going down. So I purposely step off 12, 1 o'clock, and I think that's where most of the volume is, sort of front run. That's where I like to take, most of my opportunities.
Dylan, you're trading a lot of things from what I gathered the other day over dinner, where obscure things, I even want to say. What is conviction to you in the market? I'll leave that question open.
Yeah, like Carmine said, the muscle memory thing is so important, right? Like riding your bike, right? The first times that you ride a bike, you're always in your head. You're like, oh my gosh, how am I going to make this turn? There's a bump coming. What do I do, right? And what does that cause? It causes decision fatigue, right? Hesitation, right? The more and more and more that you take a particular trade setup, the more and more it becomes like a second nature, where you see it on the chart, on the volume profile, whatever you're looking at, and you don't think twice. You know that it's go time, right? So after taking hundreds and hundreds and hundreds of setups, when I see something that I like, a relationship that I follow between different instruments, the timing aspect of different things, again, I know that it's my time to shine, and there's no second guessing. The moment you second guess is the moment that you allow your emotion to come into play, and with higher emotions, crap hits the fan in plain English.
Yeah, we had a conversation at dinner where it's like, when you see something, it's sometimes you can't even control yourself from taking it. Right?
Sure.
When you get that experience for so long, it's like, that's it, I'm in. It's not even like, oh, maybe should I get in, should I not get in? I think I can think back to when I first started trading, is I would sit there, stare at something, and sort of try to either talk myself out of it or talk myself into it. And it would be like a 10-minute period of trying to think if I should enter. And now I look at some of my best trades recently, and it's just like, I can't even control my fingers sometimes, because it's like, that's it. And
It's
I'm
a
in.
second nature.
I mean, it's just reactionary.
I have a saying is like, more thinking in the market equals less money, and less thinking equals more money. Is the less you think, the more money you're going to make, because you're going to be taking your setups. You might not win on all your setups, but if you stop thinking, you're not going to let fear creep in, and then once your emotions creep in, then your judgment is completely clouded.
I think the less thinking, though, only comes after you figure out your edge, right? Because in the beginning, if you're just not thinking, and that could be,
It'll just be
it could be a
impulses.
double-edged sword, right? But once you know what you're looking for, then it becomes less thinking.
Right. There's two main stages to trading. It's like the
Yeah.
developmental building stage. You have to trade, think, act differently in those stages versus when you actually have the edge and have the system built. You trade differently, you think differently, you act differently in the two different stages.
For sure.
Dylan, just so I can get a bit of context, how would you describe an A+ setup for yourself?
I look at a lot of different relationships between different assets, instruments, right? Everything from S&P versus NASDAQ versus the VIX, the volatility index, all the way to, say, Bitcoin versus Ethereum, how bonds react to different things, gold versus silver, crude oil versus Brent oil. So I'm looking at different, multi-asset valuations and price action, and how they line up in terms of timing, in terms of price, technical analysis. And my whole goal is to figure out an edge, right? Let's just say I see that the NASDAQ is leading the market, right? It's making higher highs, higher lows. S&P is lagging a little bit. VIX is showing some weakness, right? Now I'm looking at, okay, what sector is leading the NASDAQ, right? Now I'm looking at, say, QQQ, the spread between QQQ and the SMH, which is the semiconductor ETF, right? I'm trying to figure out what is driving that specific sector that is the strongest in the entire market. And once I can really, really pinpoint what's driving the move, now I'm going into looking at specific setups on that specific sector in that specific space. And then I try to hone in on a solid, entry that has appealing risk reward.
So one thing I want to throw here is kind of the retail individual trading versus professional. When I've had on the show a lot of traders that are just individual retail traders, it gets into these kind of comments of traps, session open, and real deep in technicals. When I've spoken to the more professional fund managers, they're very, in my eyes, just basic. It's just a very simple support level, maybe an RSI, and that's it. And then maybe a lot of fundamentals backing the idea. How is it like in your area where it's a bridge between real professional institutions and the retail as a prop firm?
A lot of it's pretty similar. I mean, don't get me wrong, there's some professionals that I know that have very, very complex styles, but then there's also some guys in my office that are very, very simple, where you almost look at them and you're like, really? Like, are you busting my chops right now? Like, seriously?
So there's not one unified strategy in the firm?
No way.
Ah, okay.
No way. No, not even in my firm. And that was one thing that I assumed going into it, that, okay, these guys have been trading together in the same office for, X plus years. They must have a very, very similar strategy so that they could all kind of collaborate into one idea. But it is not like that whatsoever.
I think that highlights an incredible point about trading, about how everyone can make money in a different way.
Yep.
It's about finding what works for you. It really gets me excited just hearing that.
Yep. One of the worst feelings as a trader is investing hundreds of dollars in a prop firm, earning your way to a payout just to get scammed by the prop firm. And I'm sure most of you are tired bouncing from website to website, not knowing who to trust, what are credible sources of information, and what are just marketing campaigns by these prop firms to trick you into spending your money with them. And that's why I'm proud to bring to you a partner of the show that is Prop Firm Match. Now, Prop Firm Match is a complete and comprehensive, trusted comparison website of all of the prop firms in the industry, where you will have verified reviews of real traders who are actually customers of the prop firm. And inside the website, you have multiple filters so you can categorize the search based on your own trading style, based on what parameters are useful and preferred for you. But beyond just that, Prop Firm Match has the best discounts in the industry for each listed prop firms, so you can get everything that you need in one place. So go ahead and click the link in the description to research the best prop firm for you and find the best prop firm discounts in the industry. Let's talk about large numbers. So prop firms, the online version, you can very easily access 100k of capital or buying power and so forth. Whereas in your guys' space, you had to earn your way, earn your lot size, as they say. When someone sees large numbers, it can amplify all the emotions from greed to fear and so forth. How would you navigate these new traders that are accessing larger capital, and in your case, other people's money? And I'm not even sure if you know how much capital you're trading behind the screen, but just in general, jumping from a small number to a big number where you earn your rights versus you just see big numbers.
I think with the online funding programs, right, you'll probably, I'm assuming, I've never done one myself, but a lot of times I'll see that those retail traders go for that heavy one, that 150K one. And what does that do? That increases emotions, because having that notional dollar amount that you're getting into, what do? You put that certification that Top Step gives on like Instagram saying, oh, I just passed an eval, right? What does that do? That increases emotions, because all of their friends are DMing them saying, oh my gosh, what do I do to make this? How do I get involved, right? It props up their like
Ego,
exactly. And so I think when they go towards that big number, right, they neglect a lot of the things that are more important, as opposed, as for like managerial side of things, risk management, trade management. So they're going for that end goal, which is like, the profits. Yeah. So they're not thinking about the risk. It's a very, very,
true,
bad road to go down.
Yeah, I think also like it's marketed as a $150,000 account, but there's a lot of things that are behind the scenes, like certain rules that they create, such as like a consistency rule, or you almost can't have big days because it's too sporadic, right? And I think this is a total, just a total negative for people that trade, because for me personally, my experience in my trading, in my P&L, it's not linear. It's very much exponential. So it's really hot periods followed by cool-off periods. And when I see something that provides fantastic opportunity, I'll look to have bigger days, right? But if you do that with some of these funding companies, they actually think that's as a negative, right? So if you have a really big day, you have to continue to have that same exact P&L number to be consistent. I find myself having very big days when I think the market's hot, and I think it's nice to have that freedom to judge how much size that I want to put in a position based on how confident I am in something that I see.
I've heard from a lot of traders that 80% of their profit comes from 20% of their trades.
I think, for options in specific, I think that is very true. I think that is possibly not as true when you get into something very structured like what Carmine does, where he can really define his risk, it's very systematic. But with options, there's going to be areas and times where things exponentially increase, and your P&L is going to have either large upside or even potentially large downside, right? A little bit more difficult to have like a perfect linear curve when you're trading with options as, a very structured product like futures.
Carmine, in your case, is it pretty much a daily setup, or many times per week?
Many different setups per day, per week. But
Okay.
I would trade the same way now that I'm trading now versus if I had $500 to my name. Like I wouldn't differentiate how I trade based off how much money I have. Because with futures, it's so easy to just manage risk properly. And once, even for like a beginner, what I'm doing now, I would do the same exact approach if I had $500 to my name, $1,000 to my name. It's the same setups. We just have to lower our risk for a smaller account and increase our risk for a larger account. And to make more money in the markets, especially in the futures world, even the stocks world, not so much options, because options are extremely leveraged. They have exponential gains, like you said. That's definitely a pro. It could also be a con of options. With futures, it's so easy to just standardize your trades. So if you have a $500 account, it's very easy to standardize, all right, my risk is only going to be $30 per trade, versus I could take $30 in a small account versus maybe make my risk in a large account $3,000. And I just amplify my wins and minimize my losses. So it's very easy to standardize, which for a beginner, I find to be necessary.
How do you navigate risk in general?
Risk in general, I actually learned from Dylan, and this was a complete game changer to my trading. Is standardizing my risk. So every trade that I take, if I were to go back and look at all my setups, ever since I started implementing this, all my setups are about the same dollar amount when I lose. So I keep my stop loss the same exact dollar amount, and I adjust my lot size or my position size to fit that risk. So if I have a wider stop loss, I'm going to go with less position size so it fits that risk. In my trading right now, my risk is around $4,500 per trade. That's how I'm comfortable losing, and I've already accepted that before I entered that setup. So worst case scenario, if I'm wrong, I'm going to lose $4,500, and that's based on my account size. So being able to adjust the position size, if I have a tighter stop loss, I could go in with technically larger size because my stop loss is wider. And I learned that from him, and it really helped me grow my account exponentially in terms of my wins were amplified and my losses were managed properly, and it kind of takes the stress off my trading because I don't always have to be right. And not only do I accept the loss before I enter, but also when I am wrong, I know that my wins are going to take care of the losing trades. So it just takes a lot of stress off, which also helps taking a lot of emotional decisions that I could have made if I didn't have, or if I did have a lot of stress.
In a environment where people are collaborating, I like the way you put it, where the online one is a conflict of interest. They want you to trip up, whereas in your environment, you want everyone to thrive because it's real money and we all want to win together. I'm wondering, as you were saying, let's say ego can come out with the certificates and the big numbers can amplify fear or greed. Is there anything equivalent within the firm in the sense of, do you guys talk about wins and subliminally keep track of who's doing well? Is it maybe even a leaderboard to incentivize each other, or is it you're all in your own lane and just in the same office?
I would say it's not very in your face, but we definitely do celebrate when other people have a very solid win or weeks of consistency and a big milestone. Like we'll go out as a firm and get drinks after work, but again, there's no in your face leaderboard that everyone sees, or we don't talk specific numbers.
Within the collaborative pool, what is taken off your hands? Because for ourselves, we have to manage from the risk to the profit taking to the setup to the ideation. Are there certain things that you have to focus on and other things that the firm takes care of?
In terms of the day-to-day, it's in your own court.
Okay.
In terms of the things that are delegated to the other people in the firm, like the risk manager, if something happens where you kind of go on tilt, you might get that phone call saying, hey, you're cut off, where they could literally probably press a button. It's never happened to me per se, but I'm sure that they could just literally press a button and your account just stops working. So again, a lot of the guys at my firm, I would say the vast majority, are trading at a very, very high level where they've had 20, 30 years under their belt where that doesn't happen. And you were asking me the other day, do I see a lot of turnover? And my answer is no. I've been there for 4 years and I have not seen a single person leave or get fired per se. So a lot of veterans are there. It's very established folks. We're not necessarily taking any average Joe off the street of New York City and saying, hey, here's a computer set up, try to do your best. So I would say a lot of us have that development before going into the firm of how to properly manage risk, how to properly manage your positions, stuff like that.
What's funny is that when you bring that up, I think your guys are watching you and making sure you're not losing money, and then the online funding companies are watching you and saying, come on, keep on trading, right? Let's blow that thing
Without
up,
a doubt.
right? And so it's just, in my opinion,
And you want to know the biggest difference is that these companies, not a real order is hitting the market versus their firm, they're executing off the market. In fact, sometimes making the market. So it's that's the big difference right there, is an actual order hitting the market or not.
Yep. That brings it to a nice point. You were mentioning over dinner how you have to actually think of ways, because your order size may actually move the market, whereas in a B-book environment, it's all demo environment.
Depends what market we're trading, but I wouldn't say that there's a lot of. I would say that there's no bullying of markets, but there are certain resources that some of the stock guys at my firm have that where they can route an order to the New York Stock Exchange and get an imbalance MOC print, as opposed to trying to get in and out during market hours. But that's not too common.
Within the online prop world, there is rules that are designed to trip you up, but there's rules nonetheless. In your space, there is free reign, but is there any regulatory pressure or regulatory rules that you have to follow that these gentlemen maybe don't have to follow the same rules and maybe can trade a bit more freely?
I'm sure some of the bigger traders at my firm have some things that they have to abide by in terms of, when they can really, really put pedal to the metal in terms of the timing into the close, stuff like that, when things might get illiquid. But for me personally, I don't really have many. Okay.
That brings me to then the question of, you guys know each other, you're friends prior and helped each other out in each other's journeys. Do you ever envy each other's paths of do you wish you were trading your own money and had that free reign? And do you guys ever think, I might take the prop route and get into a firm? How do you guys view each other's careers?
I envy his risk management, his ability to know exactly how much he's going to lose.
What exactly do you do?
Well, with options, it's very difficult, right? You don't know. You can calculate it through delta and the underlying risk that you're taking through the delta. You can get an idea of what you're going to lose on the contract, on the premium, and sort of calculated percentage of roughly what it would be. But to be able to, have a hard stop or have a level that exactly, okay, if I take X amount of contracts, it's this loss. You can't be as perfect, in my opinion, with that risk when you're trading with an option, whether that's options needing a little bit more buffer, a little bit more wiggle room. I typically will not ever use a stop loss or risk based off percentage. It's always based off a level on the market. So I like to call it like an invalidation line. Where is my thesis no longer valid? Where is the idea no longer valid based on what I see on the chart rather than a percentage-based loss? But, if something goes up and then let's say you enter at 0.1 and it goes up, let's say 5%, when it comes back to that same point, you're actually going to be down more than you would have. You won't be break even. Right? Very rarely will you actually be break even on that position due to the option Greeks. Right? So it's a little bit more of a game to play. And so with Carmine, it's like I know exactly that's just a futures game. So I envy that sometimes of the futures game, but at the same time, in my mind, it's don't teach an old dog new tricks.
Yeah.
I've done very well doing what I'm doing, and I know if I try to step into a new arena 12 years down the road, it's not going to do anything for me, right? So it's just the game I play. It's what I've signed up to do. I've done really well doing it, but there's definitely pros and cons, and that's a pro to the future side that I always look at and say, man, I wish I could be that pristine with my risk management.
Also, just the ability to break even, which I didn't realize.
I mean, you can if you just set a hard stop and a limit order at your contract price, but there's noise there that, at least me personally, I like to use just mental stop losses. I will never set like a limit order hard stop.
How about yourself? Would you ever think, let's go work with Dylan?
No, I will never envy anybody that has success and built anything on their own. So, I mean, I call Dylan up. I'll call him in the morning, be like, hey, what are you watching? And I'll call him after the market, be like, what the heck just happened? And he'll give me some information that I just don't have access to. And I'll call Vince in the morning after he's doing his thing. And I'll be like, hey, you watching this level? He goes, yeah, I'm watching the same level as you. So it's kind of collaborative. I know it's good.
For sure.
And I think that's where like the good part of having like a good community base is important too. Like even having friends in the space. Like people online might not have friends like a close relationship like we do here, but just that's again the collaborative thing. Like even in a prop firm, just calling up somebody that you're really close with and getting key information that could help build conviction to your analysis.
Yeah, I mean, I've had plenty of mornings where I'd call Carmine and we'd say the same S&P level, and it just makes me feel good to know that we're both looking at the same exact thing. And then I'll have people in my community and be like, hey, that level you told us about, Carmine's looking at the same thing. So it's like it's sort of builds the confidence.
Those are the big days.
Yeah, those are the good days.
How about just in general the idea of order flow? Now I know in the future space, whereas in CFD Forex we don't really have that accuracy. Is that something that is essential within your trading plan?
For me, I need to read the volume coming into the market. But what's cool about like Forex, I'm not sure about CFDs, is that like Forex you could trade like the euro against the US dollar, correct? So there's future contracts for that. And you could watch the future contract order flow.
And draw a parallel, yeah.
It's the same exact chart. But I think in terms of like strategy, for me, yes, that's vital. And then sitting next to these two don't really use that information. And that brings us to the point is like, there's no right way to make money in the markets, and to tell somebody that they should do this or they should watch this or they should trade this way is kind of irrelevant, because you can make money anyway. It's your way, and you have to find what your way is. And Vince doesn't use order flow, and he'll always come to me saying, hey Carmine, like, I took a similar trade with you and I didn't use the order flow. And I'm like, great, like you don't need to always have the similar tools or same ideas. You could still make money. The main objective is just to buy low and sell high. If you could do that at the end of the day, you're going to make money. And however you do it doesn't really matter. It's just the act of doing it. And we all have different ways that have found us success.
A lot of beginners watching, they probably see a lot of content online and thinking, I could learn this, I could learn that strategy. There's so many things to learn. Do you think it's good to have a mentality of be a sponge and try and learn as much as you can and then build off, or pick one route and try and master it?
Well, there's a lot of noise online, and there's a lot of conflicting signals, and there's a lot of different avenues you could go down. And there are a lot of traders, it's human nature to compare. And comparing wins. Hey, he just took a good win. I want to learn his system. He just took a really large loss. Forget about him. Like, everybody compares. And I think the greatest educator out there will be everybody's individual journal. So being a sponge and being a jack of all trades in the market, I don't think is a very good avenue to go down. Would you say,
Master of
Dale?
one.
No, I agree. It's the more, what's the saying? Analysis paralysis. When you have your hands in too many baskets. I don't think that they should pick one and stick to the one. I think that having a handful and kind of picking and choosing amongst the two or three that they kind of get into and learn, I think that would be optimal. Trying to find what resonates with you and,
Yeah, I mean, it's like, for me, there really was a moment in my career and my journey where I just said, okay, this makes sense to me. This what I look for, the break and retest setup off of these levels and creating these levels on the futures contracts and all the stuff that I do now. I can't tell you that there was like a moment in time that's like, I'm going down this road. It was just sort of naturally.
Right.
This is what really gels with my personality. I'm finding success doing it, and I'm going to continue. I think once you find some success using a single setup or strategy, you need to explore that road. And you need to, at some point, start to defend from different ideas coming into your brain. There is definitely a point where you do have to start exponentially focusing on one single thing. Like you can't, like you said, a jack of all trades, you need to be a master of one.
Mm-hmm.
That's at least I think what we've all found. Master of one, maybe there's different setups on an entry that we may look for, but at the end of the day, the master of a single a way of trading, I think is very important. So,
with the markets always evolving, changing, not necessarily in an AI revolution way. I mean, more the holiday period is a bit different to an election period is a little bit different to now tariff situation. There's going to be changes in volatility at times. And there was going to be consolidative periods, retracement periods. So with all these kind of varying market moments, would you navigate the market differently in terms of just setups, or do you think it's waiting for your condition and then trading your setup in the condition and hands off the rest of the year?
I think gaining experience, you start to understand what period you're in and how you're going to approach that period. I mean, I think that only comes after years of experience. You really can't pick up on that if you're just starting to jump in. There's periods of expansion, there's periods of risk on, risk off, periods of just dead price action. And so it's changing all of the time. And I think you have to figure out, where do you most excel? And so for me personally, when I see periods of consolidation or dead price action, I try my best to stay away from it. Option contracts, they need expansion to really appreciate. Of course, you can get into selling of options contracts, which is really ideal during consolidation periods. I just accept that I'm not an option seller. It's not something that I care to learn. I'm not interested in learning new information. I've built something that works for me, and I find when it works. When it doesn't, I stay away from when it doesn't. I don't try to always make sure I'm in a trade. What environment is it? And I need to be in a trade in every environment. I try to pick and choose where it's good for me, where it's not, stay away from where it's not, and really excel on those good moments.
How about yourself, Carmine? Because you're trading, or as Vincent, you're more finding the hot moments in the market and then executing on those, whereas you're kind of year round, you're taking place. Does that mean you have multiple playbooks?
Yeah, as long as the market's open, I can make money. And also, as long as the market's open, you can lose money as well. But I have different setups in different market conditions. And I think even like the most important and crucial point is knowing when to change and knowing when to adapt and knowing when the shift in the market comes. Like
how do you navigate that?
So like I have certain setups that when the market's consolidating or balanced or flat, I have different rules where, I don't look to maybe long the market if it's breaking out. I look to maybe reverse it and play more reversals. Okay. Versus in a market like we're seeing right now with a lot of this volatility, a lot of this tariff noise, the market's just been going straight up. So there's been a lot of trend continuations. And if I were to approach the market with a trend continuation, with a setup that I would in a consolidation phase, that's where the struggle will continue. So I have different setups. Like in a trending market, I will be looking for more like a breakout of a level. It's holding it kind of like how Vince trades, and then like finding some sign of like absorption up there. So I think it's important to differentiate the type of market you're in: volatility, no volatility, balance, consolidation, and then having different playbooks or having different setups for those. Because as long as the market's open, you can make money. And I feel like you're going to miss out if you don't have certain setups for different market conditions, because the conditions are always going to change. And you don't want to sit there and do nothing. A lot of people say, let me just sit and do nothing. Let me wait for the market to settle down or like figure itself out. But sometimes there's a great edge in that when everybody's sitting sidelined.
Yeah, I mean, there was, I think it was Tuesday or Wednesday that the market barely moved. And Carmine posted a $24,000 day. And he posted something that said balanced range rules apply.
Yeah, exactly.
And that's something that he looks for. And I was flabbergasted. I was like, I don't think I could have found an options contract that would have appreciated it all today. And I don't feel any envy from that. It's just, it's finding what's working for you.
What is that balance?
Yeah, so in balance rules, really what I look for is, so when the market's balanced, it's basically an equilibrium of buyers and sellers. The market's flat. People call it consolidation periods.
It's also, real quick, it's also where most people blow up their accounts.
Correct.
Is where it's just going nowhere, right? People usually don't blow up accounts when they're a single trend the whole day. That's actually the easiest days to trade, right? But when it's just going sideways, a lot of people that don't have some kind of a playbook in that environment start to just take random things.
Right. Well, I think that's a good point to that, is that in rules of balance is I look to fade the extremes, or I look to play reversal points, and I look for impulsive moves, where a lot of people, if they don't realize the conditions, they see a strong move up. A lot of people buy that move up, and I think an impulsive move on a period of consolidation is a very good point to reverse, because when people see the market basically being so quiet and not going anywhere, and as soon as it goes somewhere and it has an impulsive move move up, they try to hop on that bus. And that's a good opportunity for me, the setup that he's talking about, to reverse it and actually play short and sell it.
I see. So
It's a reversion to the mean.
Yeah.
So on a balanced day, everything always tries to revert back to the center. And so what happens is you'll get a big spike to the upside. Retail traders be like, oh, baby, here we go. We're about to break out. But it's a balanced day. It's not going to go. It's going to revert back to the mean. And Carmine, I think, just tries to take advantage of that emotion on a very balanced day, just to revert right back to where it came from, where people think it's, breakout, breakdown, here, the day's going to start. But it's not. It's just going to revert right back to center.
The key point here is, let's say there's a range of three touches, high and low. When it's shooting back up to the high again, are you shorting the top of the range, or do you wait for a breakout of the range, see that kind of manipulation, and then short back to the bottom of the
wherever
range?
the volume comes in? So that example was not at the top of the range. It was just an impulsive trying to bounce, and I shorted that bounce because there was significant selling activity there. And a lot of people will see like a strong green candle thinking the thing's going to bounce and move up. And when you really dive deep into the candles, I saw that there was massive selling pressure there. And I was able to capitalize on that with what a lot of people saw was bullish was actually very, very bearish. And again, that's where like the big edge comes into play, is like where a lot of traders are looking to be trapped at, or where they're going to stop out, and capitalizing on that being. And then you have somebody like Dylan, who the conditions really, I feel like, don't matter as much because he's so multi-asset.
My opinion is pretty different from what they just said, especially for newer traders, because you guys develop that skill set to recognize those conditions and kind of, have a thesis based on your feeling.
Right.
For beginners, I always recommend to have an open mind into the market, right? You have to accept that you have no idea what the market is going to do, right? If you think that the market is going to trend, guess what? It's probably going to be balanced, right? If you come into the market and you think it's going to be balanced, it's probably going to trend. And that is very, very dangerous because, again, newer traders, you come into the market thinking that it's going to be balanced. What happens? You exit a trade prematurely, go get lunch, come back to the desk, and realize that you just, had a 13-point target on the S&P, and now it's up 80 handles, right? So because they had that closed-minded, vision going into the market saying that, I think it's going to be a balanced day, right? That reflects on what they do, okay? So having an open-minded system and mind, what I believe is that you should have a systematic trade management strategy or procedure that allows you to catch the trend move if it occurs, and it will really act as an insurance policy if it doesn't, okay? Because at that point, you're taking out the guessing. It doesn't matter if it trends or if it's balanced. You will be able to capitalize if it does trend.
From a technical perspective, how do you approach and capitalize on a trending market?
Depends on the setup. But again, I give a lot of thanks to my trade management system. I have a certain procedure that does not change whether I'm trading Bitcoin, crude oil, or S&Ps. It's the same exact procedure that I use once I'm in a trade. I have no idea if it's going to hit one target or 6 targets. I have no idea, but I accept that. So if it does trend, I outsource my decision making for the exits to the process.
What is in that process?
So once I'm in the trade, right, I set my first target and my stop loss. It's in an OCO bracket, which it stands for one cancels the other. Hands off, autopilot. It's either one hits or the other gets hit.
No break even.
Nope. No,
Okay.
because break even, why would you exit at break even if that's where you entered, right? That's contradicting. If that's where your thesis became valid,
I see.
if it comes back to that, how are you going to say, it's invalid now, right? Maybe with options.
No, that's
right.
I mean, invalid. It has to break invalidation.
For sure. So once I'm in the trade, first target, stop loss, hands off, right? Because the moment I try to babysit the chart and look at every little fluctuation, emotions come into play. And that's when I'm like, damn, this doesn't look good. I think it's gonna turn. I think I'm up 2 handles. I think it's gonna turn on me. I gotta get out, right? No, set it and forget it. Again, you have no control what the market is going to do. Once the first target gets hit, stop loss becomes break even, or not break even, but where I entered originally, my average cost. Second target gets hit, the stop loss goes in between the 50% fib between the first and the first target and the stop loss, so on and so forth. So I'm giving enough room to allow for the trend to occur. And guess what? Sometimes it will pull back, and to the extent where I get stopped out and then go back, in my original desired favor. But again, it's part of the game. I have no control over that.
At these multiple levels, how do you know how much to pull out, how much of a partial to take?
Again, very systematic as well. Going with the trend, I try to capitalize on it more, where the first target I'll scale out of 25%.
Okay.
Counter trend, first target is 33%, like 1/3, give or take. Sometimes it doesn't happen, equally or like to the dime, but so everything's systematic. Again, I don't know if it's going to hit one target or 6 targets. No idea.
And it's just levels that are pre-mapped, and it's an automatic trigger, or you wait for price action at the key levels?
Automatic.
Okay.
Because again, that brings in emotions. If you see that your first target hits and your own biased opinion is saying, oh, this actually looks like it's going to go more, right? Then you're outsourcing those decisions to a biased opinion, which can really, really alter how you manage that trade. I don't do that.
Carmine, how does trade management look for you once you're in the trade in terms of break-evens and partialing or full volume?
Yeah, it's similar, like only sell if your target hits or stop loss triggers. But the way I trade, I'm looking for quick, moves, 5 minutes, 10 minutes, maybe 30 minutes. So if my target hits, it depends on the trend. It depends on the volume coming in. It's very, I guess you could say, discretionary in terms of how much I'm scaling out or if I'm even going to scale out.
If you are, let's say, more reactionary trading, are you more inclined to break even? Because price may go into your profit a bit. So if it's reversing, it means the momentum is not there that you're trading upon. So therefore, protect yourself.
Perfectly said, yeah. So what I do is, like, if I'm looking to capitalize on that short-term pain in the market, if I'm up a certain amount of points on the S&P right now, it's about 10 points. If I'm up 10 points in profit, what I'll do is I'll manage my risk. I'll put my stop loss to break even, which I know sometimes you don't agree with. But I do it because if I'm actually viewing the market and spotting either the buyers and sellers, the market theoretically should go to my target with ease, I guess we could say. So for it to kind of then pull back, once I'm in profit of a certain amount of points, pull back to where I entered, it makes my chances of that trade working out kind of less. And based off my data, it tells me if I sell here, it'll protect me from a predetermined loss more often than not.
As a trader, it's very simple. You have to find an edge, and then you have to have a mind so you can follow that edge. But how do you know if you're performing correctly or not? You have to know your data, and TradeZeller is going to show you everything that you need beyond the surface level win rates and performance and equity curve. It's going to show you detailed reports. It's going to be your back testing tool, strategy testing tool, playbooks, notes, and it's going to be a full journal. It makes your journaling easier, faster, and more meaningful. Whereas if you were just documenting it on an Excel spreadsheet or taking screenshots on your iPhone, you wouldn't be able to pull out the data that you need, the correlations that the AI within TradeZeller is pulling out for you. There's so much variety and utility within the software that I think it's essential for any trader. So the link somewhere below is going to take you directly to the TradeZeller website. I'm not getting paid. This is for you. If you want it, if you like it, go ahead and explore it, and probably you'll be using it for years to come.
So just to chime in a little bit, I'm very similar. I'm doing reaction trades, but I'm a firm believer in I break even as quick as I can, because I would rather break even a trade and miss a great opportunity than all of the losses that come in from not breaking even. So it's kind of a weighing scale. In your elements, are you more just saying let it go to target, and if it's a loss, it's a loss, but you'd rather be in the winning trades if it reverses, as opposed to I don't care about protecting and minimizing all the losses that I could have prevented?
Correct.
Because I want to be in the trades.
Correct.
Okay.
I think also, like, I do have a lot of break evens, but I feel like always have the idea of re-entering. Like always, like even if you stop out for break even, what's to say 30 seconds from now or a minute from now, you could get a better price with a tighter stop loss, which just means you could increase your position size, and a better reward and less of risk, essentially. So like I always, like, there's plenty of trades where I'll stop out for break even and a minute later I'll re-enter and I'll even get a better fill price, which just makes me, I guess, more profits if my same target hits.
And Dylan's probably sitting there like you could have just gone for
stayed
a nap.
in.
And then
That's you did that on Friday.
I did that on Friday, exactly, yeah.
Yeah, go ahead.
Go ahead.
No, I'm excited to answer this because it's such a different thing for options.
Okay.
It's drastically different, in my opinion. At least it's worked for me, right? It's depends on what works for everyone. But with an options contract, you really need to take advantage of the expansion that's going on when it's happening. And you really can't afford for something to drastically pull back against you and just like sit in the position and hope that it goes back to where it was. It's really about nailing the entry and while it's expanding, while the premium is expanding, taking off profits and not encountering a major pullback against you. The great thing about futures, right, is it's going to be the same P&L depending on where it is on the S&P. That is not going to be the same with an options premium. So if I get a quick move in my direction, as we talked about the other day, I'm always going to take off partials quickly, 10-15%. I'll always start to take some off. 25-30%. I'll start discretionarily taking things off as we get the push. Because I really don't want to encounter a deep pullback against me. I'll try to remain in a position that's pretty irrelevant to overall position, to overall P&L. So if I'm taking 100 contracts, I'll try to get down into like a 20 contract running position, and I'll be a lot more flexible with those 20 contracts to see if I can expand. Because really with options, if those last 20 contracts can expand to a 200-300% gain, those are the days and those are the positions that are really going to change a month for me. So I need to leave something on the table as long as things continue to be in my favor. I'll obviously look at things such as the S&P or the NASDAQ to say, okay, this is a very clear S&P level that I think we will see failure at. If I'm long, I'll probably preemptively exit more because I'm tracking that S&P. Hey, this is a very key supply. We're likely going to see a pullback. Let me take a little bit more off my Tesla running position because I would expect the Tesla to react with that S&P. But with the options contracts, you really need to nail and take advantage of that expansion in your favor, in my opinion, to really keep a good position and to really keep your P&L where you want it to be.
When it comes to journaling, backtesting, data, let's start off with you, Dylan. How does it look like in a professional prop firm?
Depends on the person. I don't really see it because I've been there for 4 years and the vast majority of the guys there have been there for 10, 20, 30 years. So they pretty much have a solid edge that they have 30 years, 20 years worth of data per se, where they don't necessarily have to go back in time.
They have the market experience.
Yeah. So I don't really see it much, to be honest.
What about journaling? Like recapping your week, recapping your emotions during the week?
Definitely, yeah. The vast majority of them do that.
Do you do it yourself too?
I do.
What is how do you express your own journaling?
I usually have a Google Doc where it's like a running Google Doc, which is helpful for me because I could go back to previous weeks and it's already on there. So I kind of build on certain things, whereas other things I'll kind of say like, oh, it's been a minute since I've talked about or that I've journaled X, right? XYZ. So very, very basic. It doesn't require a ton of back testing stuff. It's more so just really refining my emotions and really honing in on what types of setups work in certain markets, timing aspects.
What are the key things you're putting in? Is it just your executions and saying like good job, bad job, or is it more putting your emotions on paper and looking to see is there commonalities between market conditions and how you reacted?
Yeah, I would say the latter for sure. It's both analytical and just writing about emotions. I would say the emotional aspect is the vast majority of what I...
And do you find benefit in the act of journaling or when you come back to it and review it a week or two down the line?
I would say both because during, if I feel as though I'm going through a period of underperformance and my emotions are a little, kind of escalating or on the way up towards that escalation, I'll literally take a step back and just type some stuff out where it kind of reinforces what I'm feeling in the moment, seeing it in front of me, being away from the charts per se. So it kind of gets me back down to that equilibrium as I'm writing about it and holding myself accountable.
How about yourself, Carmine? Are you journaling often?
Yeah, so I input all my trades, and I think it brings a good point to like I'm not big into back testing once you have like a strategy. Even if you're developing a strategy, like everybody says you have to back test to be successful. I really
I've never back tested.
Yeah, I've never back tested. I think it depends on how you define back testing. What I do is I'll look back at all my trades. If you want to consider that back testing, I think
Yeah, I guess.
that's
It's
back
more
testing.
reviewing your performance.
But I think your trades and your data and your emotions will give you the best information that will give you that system or give you that advantage. Like for example, like last week there was a setup that I took on Monday or Tuesday that I lost on. And I saw the same thing occur on Friday, and I did the opposite of that setup. So being able to like review my trades and review things that I did right, things that I did wrong. Even on Monday last week, I took a setup. I don't want to call it a double top, but it was a strong passive seller at a high. Recognized it, missed the setup on Monday. But on Thursday, I took the same exact, it appeared the same exact way. And it just gave me, I guess, more conviction, kind of going to what you said earlier, is like being able to have the trial and error in all these trades, seeing what you did right. Maybe you missed something. Okay, review it. How could I have traded it better? And then you could use it to your advantage at some point in the present moment or even in the future. I do that. I think that is so important.
So it seems like your journal is there to reinforce your strategy,
Absolutely.
to keep it fresh. Before I come into you on the same question, are you doing anything else to reinforce it? Because I've spoken to traders who will have kind of a morning routine ritual where they'll have the rules on the wall or anything to that extent, pre-market routine.
No, I think it's important that over the weekend, maybe if you want to do it the day after or the night of the market closing, review your trades, review what you did, what you missed, what you saw, what you didn't see, review how you could have traded it. And that'll just give you, like every time I do this, I have so much confidence the next day in terms of the market structure, the market conditions, and it just builds more confidence in my system because it reinforces these positive things that are going on in my head. I think like writing down the rules might be good for somebody that can't follow your rules, but if you could follow your rules, I don't think that's really important.
Fair enough.
But yeah.
Yeah.
How about yourself in terms
I mean,
of journaling?
everything they're saying is, exactly what I think we all do. I think the only thing I can add to this is something that I do every single time I take a loss. I will not allow myself to enter a new position until I know exactly what happened to cause that loss. So I'll always be able to understand why the loss occurred. And typically where I find most of my losses occur is some kind of a divergence on a individual equity versus the market.
Okay.
That happens quite often and does trip me up at times. So we had this example, if a certain equity breaks under a morning low while the S&P or NASDAQ does not, and it holds that flat low and bounces off that, right? And then the equity follows. I'll sometimes get caught in some of those traps. It's just sort of something that will occur at times. And if that occurs, I always need to go back and understand, okay, what just happened? Why did that happen? Why did something I thought looked good not work? And I will make sure that I'll understand that before I progress in my trading day.
What if it's a loss that was just uncontrollable, that just didn't work out?
I almost always find a reason in my mind why.
I think that's a good thing or a bad thing that you're trying to pinpoint something wrong when it could have just been a great setup that the market didn't agree with your analysis.
Yeah, I mean, there's definitely moments in time, but I think most people can find the reason for a loss. I believe. I think there's always something that will at least give you some kind of understanding what went against you. Typically, I would say 90% of my losses is I got too aggressive inside of a balanced range. Okay. Right, so the market's just going sideways, and I'm looking for Tesla to go higher. Why am I doing that? It's probably just an emotional problem.
So when you find your reason later on of why you took the loss, is it often a case of I can fix that and now next time avoid the loss? Or in the sense of what Carmine was, I guess, trying to say is certain things are valid losses where you may find the reason, but that reason is not something you want to now introduce into your strategy, because then you'll either be too conservative and never take the winning trades that come with it.
I find that I would always everything always ends up back to not being patient enough for something to develop. That's typically where I find myself finding losing trades, is a lack of patience for something to develop, getting a little bit too clicky, a little bit too excited to take something. That's and it's this goes back to letting something develop, following your strategy. We're not always going to be perfect in following our system. There's going to be days where I try to follow something, I get a little bit excited or a little bit too interested in something to follow or to continue. So I think everything sort of stems back to that patience. Let it set up, but I'll make sure, to my first point, I'll make sure I know why that occurred before I continue to trade. Because if I continue down that road and continue to trade that same day, that's what starts to put me into, can put you into a tilt environment.
I see.
You take that loss, you don't understand why, you do it again, you take another loss, you do it again, right?
So just avoid repeating mistakes.
Exactly.
On the same
So
session.
I will do everything I can to not repeat a mistake. If I can understand why it occurred on the intraday, I'll do my best to understand that and make sure I manage sort of damage limitation. My best days do not start with losses, at least for me. My best days start with a very good win, a very confident trade that I can either continue to find opportunity. If I start the day with a red trade, I will always sort of hone back a little bit. I will not try to aggressively battle back out of that loss. I'll most of the time just accept that I read something very wrong and I need to be careful progressing down this road today. I really try to make sure, and I think this is probably what has stopped me from having blow-up days, right? Just big red days. It just doesn't happen often, because if I see myself wrong at 9:45, 10 o'clock, 30 minutes after open, and it's something I read incorrectly, I want to be careful. I want to be very cautious of how I proceed the rest of the day.
Let's talk about scaling up as a trader. So there's the prop firm answer. There's also keep your job, or online, or whatever, not even online, just businesses, or take the other people's money route. But I think a lot of people are struggling in their trading because they're trying to get huge P&L to solve a lack of capital problem. And it looks like all of you guys took a slightly different route to gaining more capital. Let's start with yourself, as because you took the most different route, which was a prop firm. Was that simply to access capital to make smaller gains mean more?
No, it was something that I always dreamt of, per se.
Okay, interesting.
Because I was telling you that me and Carmine would go and shadow. It was mainly me, but Carmine came a few times. And I just loved the energy and loved that scale. It was like the major leagues of trading for me.
Also, if I'm not mistaken, you do get a salary alongside your trading performance bonuses?
It depends on the trader, but that is, yes.
Is that something that has also helped?
Correct. Yeah. For me personally, I chose to kind of do that and then slowly wean off of that. But mentally in the beginning, because it was a very, very drastic switch going from, trading in my parents' bedroom to, trading at a legitimate firm surrounded by veterans. So
why did you decide to wean off your stability from a salary?
Because that's a lot of the other traders there have that other format, where they are solely commission based, using the profit split.
Meaning you can grow further with this approach.
100%.
Okay. How about yourself, Carmine? How would you advise people to just get more capital in their career?
Build the system. Like, a house has to be built on a strong foundation. You got to build the foundation first. A lot of people try to buy or build all the accessories of a house versus building what's holding the house up, and that's the foundation. And in your trading, your foundation is your system, is your emotional intelligence, your emotional control, your risk management. So my advice would be to start small, have small risk at first. With futures, one of the best pros of futures is being able to manage the risk, but also you don't need a lot of capital to trade futures. You could trade an S&P, a micro contract, for $40 worth of margin. Mm-hmm. So, you could do it for very minimal money needed. So with that route, your risk could be per trade $5, $10, maybe $50. Just keep the risk small, build the house, build the foundation, build your system, build your emotional intelligence, go through losses, have all these losses, and then, like I said, the losses would be your greatest wins. Your losses now might really not feel good, but my worst losses turned into my best wins now. So have this, but do it in a way that you're protecting yourself, that the losses are not taking you out of the game. Mm-hmm. And then once you have this, you've built to that foundation that you could go build everything else around it, and that's just profitability.
Mm-hmm. Yeah. I'll take a slight variation of the question, because we were going through your over lunch, your stock portfolio. Yeah. So I kind of want to speak about with you, once you have capital, once you are making money from the market, instead of trying to, let's say, just grow this one account forever and ever, but either how to pull out of it and where to put your profits in the market.
Yeah, I have a very healthy respect for risk. I've been around for 12 years, right? And I've seen big ups, big downs, at least in my own experience. And very much respect what could happen tomorrow. Tomorrow the market's not open, but let's say Monday, who knows what could happen? Something could drastically change in my performance and I could lose a lot of money. And so I always like to protect the profits that I make. Long-term investing is incredibly important to me. It's something I do, and I know, Carmine, I don't think is so much into it, so it's interesting, right? But for me, I'm always pulling out profits of my account. I'm investing that into a long-term portfolio, which is automated.
Just DCA, or do you have?
Every Monday I put an X amount of money into a portfolio that's a weighted ETF that I've created, and it just automatically puts it into there. And I can't say more good things about that over the last 5 years. I started it about 5 years ago, and it's just a gradual slope higher. And it's really helped me sort of ground myself after big trading days, trading profits, knowing that I have that in the background, and just sort of I think it's very important to be financially responsible. If you're in this game, it's very easy to sort of get a hot hand or a hot head about something that you're doing, blow it, or waste money, or get into a lifestyle that's just sort of irrational. And I think at least something that I talk to the people that talk to me and the people that I talk with, I always will say that I think it's irrational to be trading extremely aggressive without some kind of a long-term portfolio behind you. I think it's also a fantastic way to avoid FOMO in the markets.
Yeah.
So if Tesla goes up 10% and I'm like, wow, I didn't catch a single point of that with options contracts, I look at my long-term and I'm up $25,000 on shares. And so I'm just like, well, that's all right.
I'm covered,
right?
yeah.
I have it. So it's, I think, a fantastic little trick that I play. And then also if Tesla's going straight down and I'm able to trade some put options on it and have a really nice downside trade, then I look at my long-term and say, all right, I offset some of my risk in my long-term. So I like to have that in the background, always playing for me. And I know and I'm confident that when I'm 50, 60 years old, this portfolio will be something that I retire on and just pull portfolio loans off of and just have there for me. So that's very important.
I finally have a special offer to share with all of you from the US or my futures traders, which is over 20% of the listeners of the show. And that is Alpha Futures, a leading futures prop firm that is working with Trader8 and Ninja Trader that are compliant with CME regulations. With the largest end of day balance drawdown in the industry, a 90% profit split and same day payout. And with the most competitive pricing in the industry, with accounts starting at just $79. On top of that, just by being a viewer of the show, you get up to 40% off all evaluations. So why not get started with an evaluation right away, trading $50,000, $100,000, and you already know the power of prop firms and larger capital. So go ahead and use the link in the description or code TOT for the best prices in the industry, plus the best discounts in the industry to make this a home run offer if you are a futures trader.
I usually end the episode with biggest advice, but I want to change the question, which is, what is the biggest lesson a loss taught you in the market? Let's start with you, Dylan. I'm sure you've had your periods that were tough. What was something you pull out from that time and say, this is what it taught me now?
I feel like down to the fact that losses are inevitable. They're going to happen. Whether you're a novice trader or a veteran, everyone experiences losses, right? Single losses, periods of sustained underperformance, whether that is a week, a couple weeks, so on and so forth. So it's going to happen. Never let one trade shift the way you look at the managerial side of things and the overall performance, right? Don't let one bad week, really, really shift the longer sustainability focus and vision. So again, you'll have big losses throughout the career, or relative. Like a big loss to Vince might be $30,000, whereas someone that has a very similar, system as him might lose $300 and be upset with it. So I don't think the dollar notional amount of the trade or of the loss, win, doesn't matter, should be even in this conversation. But just accepting that losses are inevitable and you have to move on from it, and you shouldn't have a different mentality for that subsequent trade, right? If you hold on to the loss that you just took and it's still bothering you, right, and it's frustrating you, you're gonna manage that next trade very, very differently, and that's a massive flaw.
Carmine, how would you explain the biggest loss you took in the market and what's taught you?
Know before you enter that setup, know why you're entering that setup. So there would be plenty of times where I would just enter a trade because I thought I was going to go up or down. And I feel like that's a huge issue with a lot of traders. Is like I always say to like people that like follow me is that like act like I'm there right next to you trading. And I think in a firm setting, I think this is like a good advantage is like act like somebody is there watching you. It's so lonely, trading from an office, trading from a bedroom, wherever. Act like I'm there watching you, and if I'm asking you why you're taking that setup, you have to give me a good reason why you're taking that setup. What's your thesis? What's your plan? Where's your stop loss? Why is your stop loss there? Why is your target placed at certain points? And if you can actually label the trade, the setup, or label the playbook that it comes from, you have a good reason to take that setup. And I think that'll keep people on their toes. It keeps me on my toes. Like it helps me not force setups based on where I think the market will head next. Right?
Does that mean you don't really allow intuition or a gut feeling to come into play?
Well, intuition and gut feeling, I think, has a really good advantage for traders that have experience, absolutely. But to make a buy or sell decision based off your gut is not a good feeling. It could help understand which way the wind is blowing or help understand which way the market's leaning towards. Okay. But not so much, hey, like my gut's telling me the market's going to go up, let me buy it. So being able to say, hey, Vince is watching me trade right now. Vince, I'm taking this setup because this is a trap buyer's playbook out of my system. And that'll help me keep me on my toes to only take that setup and not force it.
I think for you, just the live streaming habits, you're in front of people executing. So you got that accountability of people watching over and you won't do silly things.
I actually say that quite a bit is my openness of my trading actually I think has benefited me because I can't be taking ridiculous risky trades that make no sense in front of people that are watching me trade. So I think that actually keeps me quite accountable, and something that I really agree with Carmine is trading, you can just be there all day, no one's going to tell you what's right and what's wrong, so you really need to be accountable to yourself. And to sort of answer your question, something that I wanted to bring up was in the beginning of my trading career, my P&L was always a very gradual upside move that was a very consistent trading, followed by pretty much a straight down give back over a 1 or 2 day period.
Oh, wow.
So,
okay.
I mean, this happened for probably months, if not years. I would consistently see the same thing, same problem that would continue to come into my trading. And I would like to say that today I look back at that and I can't say how, for me, that was so important.
How did you solve that boom and bust kind of?
So knowing that is what happened to me in the past, I have now been able to understand sort of what that day looks like, right? Because I've been through it. So I can sort of think back and think about how I felt during that bust day and what emotions would creep in and the things that I would do, the trades that I would take, the reactions I would start to do on the intraday when I start to see that, bust day coming in. So there's days even now where I'm like, I know how I can feel this, something's happening, right? And I can think back quickly and say, okay, I know how this ends.
Close
right?
the laptop, walk
yeah,
away.
And I know exactly, I've been through this for years. I know exactly what this day ends. And I couldn't avoid that without going through it, right? So I think if you are in that period where you're taking losses, experiencing problems, it's going to help you if you continue to fight through it. That will help you in the future because you're going to be able to refer back to those days, understand what you went through. A new trader doesn't know what that feels like. So how would they avoid something without knowing what it feels like?
Yeah.
So I think that was instrumental to where I am today.
Yeah, I think that speaks volumes to the power of market experience.
Yeah, 100%.
Gents, thank you very much for joining me on stage today. Epic episode.
Awesome. Thank
Well,
you.
thank you.
There we go.
Awesome.